everyone for joining us on the third and I guess the final day of the TD Securities Virtual Energy Conference. The next series of panels are going to be focused on the royalty space. If you don't know me, my name is Aaron Belkowski. I'm a research analyst at TD. I've been with the firm for a little over a decade. I have a specific focus in U.S. and Canadian listed energy royalties, so I would cover Prairie Sky, Freehold, Viper, and now Kimball. With us for this 20-minute session would be Andrew Phillips, President and CEO of Prairie Sky. I have a handful of questions that I think are interesting in the current environment. I hope you find them interesting too, but I really do encourage anybody on the line to ask a question using the text box on the left-hand side of the screen. It's easy, you type in the question. I'll ask Andrew. With that, I'll turn the line over to Andrew to briefly speak to key themes he hopes investors will take away from this panel, and then we'll jump into a more targeted Q&A. Andrew, I'll turn the phone line over to you.
Well, thanks very much, Aaron, and thanks to TD for hosting this virtual conference. And I saw you picked up coverage on Kimball Royalty Partners today, so that's good. The more research coverage there is in our space, I think, is a good thing for the whole space. So appreciate there's a lot of people dropping coverage, so appreciate you guys picking up coverage. Prairie Sky is the largest royalty owner in Canada with 15.6 million acres across the basin, or 1.5 times the surface area of Switzerland. Our shareholders own 65% of all of Canada's fee title land, stretching across the entire Western Canadian Sedimentary Basin. Past 6 years, we've returned $1.2 billion in dividends and buybacks, all out of free cash flow after tax and after G&A. This represents over half of our market capitalization. This is while remaining debt-free, which is the benefit of having a capital-light business with 97% operating margins in all price cycles. The moat around our business is owning perpetual mineral title dating back to the late 1800s that is irreplicable. Prairie Sky lands attract approximately 5% of all upstream capital expenditures in Canada, the world's fourth largest oil producer. Over 320 companies pay us royalties on a monthly basis, from senior integrated producers to junior startup companies. And in addition to the $1.2 billion of real cash returns to shareholders, Prairie Sky has taken $150 million of excess free cash flow to reinvest in royalties in the best parts of the cost curve in the basin, including the Viking, Montney, and an 850,000 acre position in the Clearwater oil play, the fastest growing oil play in Canada, with a new 50,000 barrel capacity pipeline that just went into service. Looking into the future, Prairie Sky has a dividend payout ratio below 50% over the next 18 months, allowing for sustainable dividends, share buybacks, and acquisitions. So that was just a quick overview, Aaron, and I welcome any questions.
Perfect. Let's just jump into sort of the elephant in the room, at least it was in Q2. On the Q1 conference call, you expressed your concern or your anticipation about third-party shut-ins on your land. How did that ultimately result relative to your initial expectations? And what have we seen since the commodity prices recovered in terms of producers bringing back on previously shut-in volumes?
Yeah, and so because we're releasing Q2 shortly, I'll kind of reiterate what I said on the Q1 conference call. And at the time, corporates were guiding us to about 20%, but based on field netbacks, we were budgeting for closer to 30% in Q2. And then after our call, oil price obviously went negative, which sped up the process. And, you know, just to reiterate again, we were and are supportive of shut-ins to preserve economic value of the jointly owned resource, even when we still have 97% operating margins. So as for the pace at which it's coming back, you're seeing a lot of the lighter barrels have mostly come back on. Some of the heavier barrels take some time, in particular the SAGD projects, which represent about 14% of our production prior to the COVID pandemic. And that 14% takes a little bit of time just because of the steaming and putting the wells back on. So some of the heavier oils are slower to come back on, but we would expect a recovery throughout Q3 if pricing stays where it is.
On the shut-in side, when a producer elects to or decides to shut in production on your acreage, how does the process work? I'm assuming it's fee title land. Do they reach out to you and ask for permission? And is there a period that you allow them to do that? Is it a 3-month reprieve from producing the well, or is it an indefinite option on their part? Just practically speaking, how does it work?
Yeah, it's not an indefinite option, and typically you have to contact us and get permission to shut in production, and you can shut it in for about 1 month before you can be in breach of your contract. So most of the producers are aware of this, and they'll call us and try and work with us on shut-ins. And again, we do remain supportive, especially when the netbacks are very low and you want to preserve economic value. But we can say no if we choose to.
Okay. And I guess final question on the shut-ins. Is there a certain period of time where if a producer continues to keep volume shut in, you either take something from them in terms of a gross overriding royalty elsewhere, or you take the land back, or is that not even in the near-term horizon?
Yeah, the land back is something that we have done in the past, and probably a past example of this would be on the natural gas side. When some of the natural gas resources became uneconomic during the last 5 years while pricing was very low, there were a bunch of shut-ins, and we did actually take the lands back. And in some cases today, because there's stronger pricing and a better strip, people are trying to put those wells back on production. But of course, they just have a dummy lease, so a lease that doesn't have the zone that they would produce from. So we're doing new leasing with those companies now to get some of those old gas pools back on, and a similar thing would happen on the oil side. And typically, we want to see abandonments happen if the wells are uneconomic or we don't believe they can produce in the future. So we'll typically send abandonment notices upon wells being shut in.
Perfect. Maybe shifting gears a little bit from shutting in existing production to future drilling and incentivizing incremental capital spending. Most producers have obviously talked about limiting capital to the back half of the year, going into maintenance capex mode at best, or allowing their volumes to decline. How does Prairie Sky maximize its ability to replenish volumes in this environment? Are you implementing incentives to help producers, make it easier for producers to drill more wells? Just how do you think about maximizing value in what's clearly a challenging environment for your counterparties?
Yeah, I think one of the things we've always done in the challenging price environments, whether it's gas or now oil, is just encourage exploration with some upfront royalty incentives. And part of the reason we want to do that is it's expanding the resource base. It's stuff that you wouldn't see in the royalty playbook or handbook because it's a brand new exploration well. So in those cases, places where you can drill one well and prove up another 50, those are situations where we'll give royalty incentives. The other piece is if companies are looking to do polymer floods or water floods, which sometimes take 2 years of injection before you start to see the results of the increased oil production, we'll give some upfront incentives for people to maximize the resource that way. But I guess on the other side, we're working with privates that still have pristine balance sheets, and we've done some recent leasing with some well-capitalized privates. But primarily, you kind of have to let market forces dictate the pace of development, and there's just not a lot of capital out there right now, Aaron.
Sure, I get that. This is going to be a general question, but do you see a quicker return of spending on the private side or the public side?
I think the private side, based on the indications from producers. Now we're just coming out of breakup, so the actual, we haven't seen a bunch of licensing, mostly in the Deep Basin and the Montney, but it's too early to see the actual results of that. But I think from talking to the producers, the privates seem to view this as an opportunity to get a little more active. I think the publics, the indications we've had from them are that Q3, Q4 we'll see a little more activity, which will kind of jump into their 2021 programs.
Okay. We have a comment from or a question from the audience. It says, how do royalty companies need to think about revenues received in the context of ESG? Is there a contemplation to consider more royalties across the energy value chain through to renewables, presuming the math works out for putting encumbrance on these type of assets, especially if drilling in Canada subsides? So how do you think about
we look at
you step out into renewables?
For sure, yeah, and we've done a lot of work on ESG recently, and it's an important cornerstone, I think, to investing in Prairie Sky, just given our very low Scope 1 and 2 emissions. We have done a bunch of work on renewables, and we've looked at solar and wind. I think probably where we would fit into the value chain there would be displacing coal with natural gas power, whether it comes from us leasing natural gas resource or having some kind of royalty on the power that comes out of it. But we'll continue to look at those opportunities. One of the challenges is most of the economics are just in the government incentives, and the IRRs are extremely low. So it's a challenging space to find economic value. The other part is, we're a company that likes optionality, and 7 years from now, if you and I are on the phone, there'll be some other resource that I couldn't tell you about today that's contributing 10% of our royalty production, and we already own it. We just don't know where it is. Whereas with a lot of those other renewables, you don't get that optionality associated with our business.
Gotcha. So if I can maybe interpret what you're saying, you're basically saying the mineral fee title royalty game is basically a perpetual business with perpetual optionality, but going into the renewable side, you view it as like a finite life. Is that fair?
That's fair, and I certainly think we'll continue to look at it, and we're in a unique position, unlike most energy businesses, where we do have a lot of excess free cash flow. And again, so we do have, we'll look at all opportunities in front of us, and we like to learn as well, but that's, I think you've nailed it with your comment.
I guess, and this might be a related question, but not necessarily on renewables, like Topaz is entering the royalty market. Part of their business strategy is to have a more diversified product mix and less commodity linked, and by that I mean they're going to enter a bunch of take-or-pay contracts on midstream type infrastructure.
Right.
Do you see Prairie Sky going down that road, or do you feel as though that's just a different business that you're not going to be involved with?
Yeah, and I know we always look at these outside opportunities. They typically, again, lack the optionality associated with our business. Gathering and processing revenues are wonderful, stable revenue streams, but the fresh capital investments required to build another compressor station or a gas plant on the next big play. And the mode around our business, having fee title lands never expire, are half developed and have a long duration cash flow stream. And you just can't replicate or buy our fee, but any financial partner can buy GMP assets. So again, every trading day when we cancel Prairie Sky shares, we're buying a low decline, long duration cash flow stream at a 7% unlevered free cash flow yield, and a large undeveloped land base as well that will provide free cash flow 5, 10, and 15 years out. So it's kind of hard to replicate what we have. I would say on the Topaz front, we're excited to have Topaz enter the public space, as it'll be an excellent company and bring more exposure to the royalty space. And they'll also have one of the top gas royalty assets, I think, in North America. We're really impressed by the royalty asset they have. But on the GMP side, or gathering and processing side, we just don't see ourselves fitting into that space. And I think a lot of the companies that participate in the midstream space or the gathering and processing space have pretty good cost of capital. And again, it just doesn't have the optionality associated with our business.
Yeah, fair. I'm just going to transition a little bit over to dividends and free cash flow and use of free cash flow. So during the downturn, you made a pretty substantial change to your dividend. Based on my math, it's sustainable. You could fund it with cash flow down to WTI prices that are quite low in the $20 barrel range. Hopefully we don't revisit that. Could you walk us through how you view your dividend payout policy going forward?
Yeah, and when you look back the last 3 years, we've paid over $180 million in dividends annually and had in the range of $40 million each year left over to buy back stock or make acquisitions with. And it was kind of an environment where we didn't see a lot of opportunities that met our acquisition hurdles. So we did very few acquisitions in that period of time, and we're able to pay out, a lot of that cash flow. When you look at the business today, we obviously have a low payout ratio, which will allow for acquisitions and/or buybacks with that excess free cash flow. And we will continue to review the dividend annually and hope to enhance the potential of dividend growth in the business by taking advantage of this downturn. And it's an ideally suited dividend-paying company with high operating margins and low costs. And again, when you look at this downturn, what makes it different than other downturns is the last downturn we issued shares at $25.90 to buy Canadian Natural Resources, other large royalty portfolio, and today our business trades at a 7% free cash flow yield at the bottom of the capital cycle and the bottom of the price cycle. So some of the best opportunities we see right now are in buying back stock, and I think if I were to say, we found an acquisition that's got a 7% free cash flow yield at the bottom of the cycle, and by the way, you also get a massive undeveloped land portfolio with it, you'd say, well, that's something you should buy, and that's our business right now. So again, we're cancel shares every trading day, and I think there's a lot of value in that, and it'll really give the potential for us over a 3, 5, and 10-year period to enhance the dividend-paying potential of the business.
Okay. And you alluded to it, but on the M&A side, have you seen this challenging commodity price environment and maybe challenging credit environment and equity environment result in incremental royalties being marketed?
We've seen a lot, and actually we bid on a number of them, and we actually worked really hard over the last 4 months and probably bid on about 7 different packages of various sizes. And a lot of the sellers are expecting higher than strip when they're with their expectations and pretty low IRRs. So again, it's been fairly active, but I think buyers and sellers are a ways apart. And the other thing, and we've talked to you about this prior to this, Aaron, but we always try and improve our business and get assets that are on a better part of the cost curve and try and get a higher percentage share of the capital that gets spent in Canada. And a lot of the assets we've seen and the companies we've seen that have marketed them on a small scale have been, they've got challenged balance sheets and assets that new wells don't pay out in a reasonable amount of time to not require external equity and debt. So we're trying to improve the business per share, and I think it's difficult to do, and we always compare it with buying back stock, and that's a challenging thing to do for us right now. But we'll continue to work hard on the asset opportunities, and hopefully something comes available. And we'd love to partner with a really high-quality company who's trying to expand their business and partner with them as a source of capital potentially, and that's one of the places we're looking to potentially sit in the market.
All right, and when you look at those opportunities with a company that may be looking to expand its business, are you still exclusively looking in Canada?
We are, yeah. We're, again, there's been a few smaller packages in the U.S. and one corporate that was looking to sell, but we do look at the U.S. opportunities just to stay smart on them, but again, we'll stick to what we know, which is Canada.
When you look at land values over time, how volatile is the value of undeveloped fee title land? Maybe since you've started
right.
Prairie Sky, does it swing with the commodity cycles, or is it relatively sticky?
Well, you could use Prairie Sky as a proxy, and right now, our lands, which I think are at a far better part of the cost curve than they were when we IPO'd, because we've spent our entire existence over the last 6 years trying to improve the business per share and try and get into plays that have quicker payouts and better economics. And at the time of the IPO that you guys led, we issued 130 million shares and had 5.2 million acres, so you were well over $500 an acre per fee at that point, and then today you're trading in the hundreds. So they're down about 5 times, and it's the same business, and I think that's just a result of the cycle. And you kind of thought a business like ours that has kind of a 50-year runway, and there's more value in year 2 to 40 than there is in the first year or the near-term pricing, would have a little more stable share price, but it's clearly fee in our business anyway is valued quite a bit lower. We still put tremendous value on the fee simple lands we own, especially because they're contiguous, they're all rights, which is unique in North America. Most of the U.S. royalties are very fractionated, small interests, sometimes only zonal, and you don't have these contiguous blocks that you can work with producers on. So they've definitely come down, but I think the best ones, like if you think about Chevron's Permian position where they have the 15/16 interest, I don't think they would sell that for any price. So I think, again, the quality acreage still would be expensive, I believe.
Okay, that's a good answer. And this is probably going to be my final question because we're down to our last minute, but something that's been topical, we've seen a handful of companies go through restructurings in Canada. Some had midstream commitments that were renegotiated through that bankruptcy process. Could you talk a little bit or remind us about how royalties, either fee title or gross overriding royalty contracts, fit in the pecking order during a bankruptcy process?
You bet, yeah. So all of our gross overriding royalties or fee simple lands are interest in lands. So we actually have the ownership of the resource, so it cannot be renegotiated or extinguished during the bankruptcy process. So we've seen over 40 companies work their way through the bankruptcy proceeding, and the GOR and/or the fee title lands, of course, those same contracts go through to the ultimate producer who ends up acquiring them through the proceeding. So we're super secured on that front.
And I guess maybe a part B to that question. Is there a delay in a bankruptcy process that you would, is there a delay in collecting royalties, or is it basically seamless from the royalty holder's perspective?
Yeah, it's actually faster, more efficient, and interestingly enough, we typically, those companies that are getting close to bankruptcy, they struggle. We're always bugging them. You know, you're 2 weeks late, and in a lot of cases, for the ones that are in the weaker balance sheets, we take the production in kind to start with anyway. But typically, KPMG or whoever the receiver or Ernst & Young, they're paying the royalties very, very efficiently and on time, because that's the only way for them to keep their asset. And one receiver actually stopped paying them and just said, we're not going to pay them. So we said, okay, well, that's fine. And we sent them abandonment notices for their entire oil field, and they quickly paid their royalties. And I think that's the lesson with royalties is we're the owner of the resource, and you have to continue to pay them to keep your contracts in good standing, or we can effectively kick you out of your apartment, if you want to think of it like that.
Perfect. We're out of time, guys. Thank you very much, Andrew, for taking the time to talk.